include it in income, you exclude it in your gross income on your tax return because there's a tax law that says you can exclude it. So we're going to go through those types of items. So there's a difference between exclusions and items that are not income. We're going to talk about the difference between exclusions and items that are not considered income. What are some commonly encountered income exclusions? So we're not going to go through all of them because there's just way too many. We're just going to go over some common ones. What receipts can be excluded under a tax benefit rule? And what is the tax benefit rule? And then strategies. So as always, we have a big picture. So Paul is a graduate accounting student with an intern with a CPA firm. The firm was so pleased with his work that at the conclusion of his internship, he was given a bonus of $2,500, more than what the firm agreed to pay him. The amount was intended to help with his graduate school expenses. The CPA firm has offered him a full-time job after he completes its graduate program in December. Okay, some of the facts. Because of his excellent academic record, Paul was awarded a graduate assistantship that waives his tuition of $6,000 per semester and pays him $400 per month. He's required to teach a Principles of Accounting course each semester. He's used $400 per month for books, for room and board. In November, Paul was hit by a delivery van. The driver was found to be driving under the influence of alcohol. He suffered a severe injury to his right arm that delayed his starting date for work by 3 months. The delivery company's insurance company settled the case by paying the following damages. So there's compensatory damages, which are these, and there's punitive damages. His mother was with him in the crosswalk. Unfortunately, the van did not hit her. She was not physically injured. She did suffer emotional distress and received $25,000 in the settlement. Besides being Paul's friend, you're also a senior accounting major and you have a keen interest in taxation and you want to help him. Let's go through these again. The questions are these included? Are they excluded? And if they are included, is there a limit? Okay, so is this bonus going to be included as income? Does it matter that this bonus was received to help with his graduate school expenses or no? Does it matter? They offered him a full-time job that starts in December. And with that, he was awarded a graduateship and that waives his tuition. So he's actually saving the $6,000 of tuition. Is that included income? They also pay him $400 per month as the graduate assistantship. Is that considered income? He's required to teach a principles course. He's used the $400 for books, for room and board. Does it matter if he gets paid $400 and it's used for room and board? We're going to find out these rules. He was hit by a delivery van. So he was actually severely injured. Does it matter if he's injured or not injured to decide upon what is considered included in income or not included in income? So is the compensatory damages included in income or not included in income? And is there an extent? Are the punitive damages included or not included? And if they are included, to what extent? The mother received $25,000. She was not hit. She was not physically injured. Does that matter? Does she include this in her income? So that's basically the questions that we are going to be asking. So let's just talk about what income exclusion means. It means something that should be in the tax base is removed. So when we talked about the tax base, that was on the first chapter, where we added up all the income and then we multiplied by the tax rate. So the amount of income is what you're going to have in your gross income. So if we go to, just move this out of the way, Form 1040, right? So when we talk about our total income, right? Our total income minus our adjustments to income give us our adjusted gross income. So everything that we have, everything that's in 2A, 3A, 4A, 5A, 6A is not included in this because this line only adds up the B's, the 2A, B, 3, 2B, 3B, 4B, 5B, 6B. Doesn't include. So these are not included. They're excluded. Well, there's other types of items that are not included either, which gets us down to our gross income. So the question is, what of these things, something that should be in the tax space is removed because there's a provision. There's a tax law provision that says you have an exclusion for this. The exclusions are in the IRS code section 101 through 140. So you can read them all there. Here's some examples of exclusions. Some exclusions, why do we have them? They're giving a tax relief measure, right? So let's think about this way. Paul's hit by a delivery van. He's getting these damages paid for. Should he, is he making money because he's just making money, or is he getting paid back to compensate him for his losses? Should we tax him on that? Should we not tax him on that, right? So we're trying to create tax relief measures. So some exclusions are because we want to give tax relief. We don't want somebody to pay when there's already a problem, maybe. To encourage and support certain activities. So, for example, there's lots of areas in New York that they offer income exclusions or lower tax rates if you bring your business into a certain area to bring up the economy in that area. So we want to support certain activities. It's also the design of the income tax to create exclusions. There's a general rule and then exclusions. So what's the difference between exclusion and non-income? Okay, an exclusion is to specified income items. A gift is an income, but it's excluded and not part of gross income. So in contrast, borrowing from a bank are not income because there's no offsetting liability to repay. The return of capital is an example of something that is not income. So what does that mean? If I receive a gift from somebody, I have benefited from that. And the person who gave me that gift has an offsetting liability per se, right? In the sense of a payable that then they paid me. So I don't include that in my income, but the person giving me a gift will include that as in their income, because gift is very specific, okay? So it's excluded from my income. It's not part of my gross income because a gift given is in the other person's income. Now, if I borrow from a bank and then they give me money, there's a liability. I owe the bank. They're giving, let's say I get a loan for $20,000. The bank is giving me the $20,000, but I have to pay that back. So I'm not going to pay tax on that money that I received because I have to pay it back. There's a liability of having to pay it back. I have to repay it. So that's a non-income item. I'm receiving money, but it's not income because I have to give it back. So that's kind of examples. Corporate distributions. We went through this before. So exclusions versus non-income. If I deposit money into a bank, that's my return of capital. I went through this last chapter. The money that I made is a return on capital. So this would not be income. This would be income. If I went to a corporation and I contributed $5,000 of stock, every dividend that they gave me would not be taxable, would not be included in income up to the $5,000 contribution. Anything above the $5,000, if I add all this up, it's $4,400. So if I got a $600 dividend, this is my $5,000. None of this is taxable. So if I got a dividend of 1,000, but there's only 600 left, 600 is non-taxable, but the other 400 is. We did this in the last chapter, right? Because our capital can't go below zero. Yeah. So that's an example of what they're trying to say, right? So that's So that's kind of what we're talking about. So let's go back to the power here. So corporate distributions, when there's a payment made to you with respect to your stock, distributions are taxed as dividends to the extent of payments made from either current or accumulated earnings and profits. That is something the current and accumulated profits and earnings we're not going to get into. That would be in accounting 449. But this is assuming you've already received all of your $5,000 back. Okay. This $5,000 is already, and now you're getting another dividend. And after that, anything in excess of earnings and profits, it's a whole other type of calculation. So there's the first step. Once you get all your contribution back, after that, every dividend goes through an earnings and accumulated earnings and profits calculation. And that part of the dividend would be taxable and the other part would not be. And sometimes it's all taxable, but we're not going to go through that. But just know that part of it would be non-taxable. That's your qualified dividend. And some of it would be taxable. And the calculation after you've returned back all of your contribution is based on current and accumulated profits of the business, the company that you own the stock from. A stock dividend. Let's say, for example, you own a corporation, stock in a corporation, and they don't give you a dividend of cash. They give you a dividend of another piece of stock. Stock dividends are not taxable. Okay. If the shareholder has the option to receive stock or cash, the gross income is taxable whether the shareholder receives cash or stock. Okay. You can read those knowledge things. Gifts and inheritances. I went through this in the first chapter as well. Gifts are taxed to the donee. So if I give you a gift of $10,000, you're not taxed on the gift. I'm taxed on the gift. And the reason why is the only place really where you find it kind of the opposite of what makes sense. And the reason why is that a lot of people will want to get rid of money to get a deduction on their return as a gift. But if they give money to different people over a certain amount, then they're getting all the deduction. And then the person receiving the gift, who maybe they don't want the gift, maybe they can't afford the gift. They might have gotten a car, but they can't afford the taxes to pay for the gift of the car. So the IRS has said, you know what? The person who's receiving the gift is not going to be taxed. The person who's giving the gift is going to be taxed. So gifts are non-taxable to the donee. They're taxed by the donor. If the transfer is voluntary without adequate consideration, and it's made out of affection, respect, or admiration, like a charity or like impulses, it's not intended to be for services rendered, which is hard to see. It's hard to prove that, right? Inheritance are non-taxable to the beneficiary for federal tax purposes, but for state tax purposes, it's different, okay? But we're talking about federal. So inheritances are non-taxable to the beneficiary. So that means if I die and I have left to you $20,000 for federal tax purposes, you're not taxed on receiving the $20,000. State tax purposes, you may, depending on what state you are in. But for federal purposes, you're not taxed. Income earned on gifts is taxable. So let's say I gave you a gift of $10,000 and you put it into, and I have it set up in a savings account for you already. So I gave you a gift. I opened up a savings account. I put $10,000 into it for you, and it's now your account. And let's say that $10,000 is non-taxable to you. But let's say you keep the money there and you earn 3% interest. You earn $30. The $30, which is the income earned on the gift, right? The $30 was earned on the 10,000. That's now taxable to you, because anything after you receiving the gift, anything that's earned on that gift that you have to pay income tax on that. Okay. If an employer transfers something to an employee, they are not excludable gifts. Those have to be very specific because generally they're considered compensation, unless it's an employee achievement award. For example, not we're giving you an award because you brought in, 5% more clients. That's more like a bonus. That's like compensation. But let's say you started a charity fundraiser and you got everybody in the office to walk a 5K to raise money for Alzheimer's or something like that, and your team raised $20,000 for the charity. That would be an achievement award that they would want to give you to say thank you for bringing our people together, thank you for having our corporate name out there for something good. So it's not related to your job. It's something that's outside. Or maybe it could be you've been with the company for 20 years, right? That's an achievement. They might give you an award. That whatever award you receive for that would not be considered income to you. Victims of a qualified disaster who are reimbursed by their employer for living expenses or funeral expenses can exclude those payments from gross income. So you have a disaster, right? So let's go back to what they're saying here. They want to have a tax relief measure for you, right? So if your employer is helping to help you because you had a disaster, they're not going to, tax you on receiving help because you were in a disaster, right? Because generally, when you talk about income, it makes you better off. But if there's a disaster, we're hoping that whatever gift you're getting or whatever money you're getting is making you back to be equal. So they're trying to not tax you if it's made you whole again or possibly partly whole again. It's if you have received income that makes you better off than what you were before. Think about it that way. An employee death benefit, an amount paid by the employer to a deceased employee's surviving spouse, children, or other beneficiaries. So what happens sometimes is, like when I used to work at PricewaterhouseCoopers, they had a life insurance policy for me, and it was for me, and I had the beneficiary being my niece and my 3 nephews. So even though my employer was paying the life insurance policy on my behalf, my family would receive those benefits. So it's kind of still the same that it wouldn't be taxable to my beneficiaries. Okay. And group term life insurance. If the employer makes voluntary payments to the family of the deceased employee, the facts and circumstances are very different depending on the situation. So sometimes it can be a gift, sometimes it can be sometimes it can be inheritance, sometimes it could be taxable. So it'll all depend on the different types of circumstances. But sometimes it could be taxed or not taxed. So let's say back to the big picture. The $1,500 paid to Paul by his summer employer was compensation for his services rather than a gift. The payment was most likely not motivated by the employee's generosity, but was as a result of his business consideration. Even if the payment was made out of his generosity, because the payment was received from his employer, Paul could not exclude the gift because it was based on his work, not like an achievement. Like he did well at work, they said. That's him doing well at work. That's compensation. What is life insurance? Life insurance is you go out and you buy an insurance policy. And it's basically, they're all different types. And it says, if I die, my beneficiaries will get X amount of dollars. And that X amount of dollars would be dependent on how much you're going to pay each month for this life insurance. So it's just like health insurance, right? You pay every month to keep your health insurance alive so that when you need to go to the doctor, or you need to go into the hospital, that health insurance is there. So every month you pay, you'll have health insurance. Every month you pay your life insurance, it'll be alive that when you do pass, as long as your life insurance is paid up, then whatever the life insurance is supposed to pay to your beneficiary will be paid. So whatever is paid to the beneficiary is excluded from the gross income of the beneficiary. So let's say I have a life insurance policy, and if I die, you're my beneficiary. So when I die and you receive the $10,000 from my life insurance, you do not include that in your income because life insurance proceeds are excluded from your gross income. And then there's some examples of what would be exempt. And accelerated death benefits. So what is that? So let's say now I bought my life insurance policy and I pay my life insurance. Some life insurance policies have this surrender value, some do not. So let's say every month I pay $200 to my life insurance company. And let's say I've been paying for the last 7 years, right? So $200 times 12, let me do this fast on my calculator. So $200 a month times 12 months times 7 years is $16,800. So I paid $16,800 to the insurance company. And that $16,800 is the cash I've paid. And then part of the $16,800 is reserved for the cost of the life insurance company creating the policy for me and carrying it. Some of that is for other types of costs, and some of it is going toward my investment. But let's say I decide, okay, I paid $16,800. I don't want this life. Let's say I was married and I got a life insurance policy, and that the beneficiary was going to be my spouse. And now we're divorced. So I don't want the life insurance policy anymore. Well, some insurance policies will give you a cash surrender value, which means you're surrendering the policy, you don't want it anymore, and they're going to give you some cash back. It won't be the whole $16,800 because they have to get their payments and stuff like that. It's probably usually about 20% or 30%. It depends on the policy. Well, if you receive that $16,800, some of it will be taxable. But if you are terminally or chronically ill, then you don't have to include it in your income. Because usually they want that money for long-term care. So again, the IRS doesn't want to put you in more of a hole. If the policy is transferred for valuable consideration, i.e., I transfer to somebody else and I get consideration back, or I transfer one policy from one life insurance policy company to another life insurance policy company, whatever proceeds I receive from that transfer, I might receive money back. Because let's say one insurance policy, the cost is, $300. And then the new policy is only $200 a month. Well, that extra $100 a month, I might get back. I'm being very simple, but it doesn't work that way. Okay. Whatever proceeds I receive, that extra $100, that could be taxable to me to the extent they exceed the amount paid for the policy plus subsequent premiums paid. So I have to pay my premiums every month. I switch it to get valuable consideration back, but that consideration back is also part of it's going to pay for my policy and payments, subsequent payments that are going to happen. So whatever that difference is, that part I'd be taxable. Exceptions exist if I transfer the policy to the insured under the policy or the partner of the insured. Then there's an exception that we don't include that in income. So what are we talking about here? We're talking about, am I including this in my income to be taxed on it? Okay, so here's some more examples of transfers. And you can read those. Scholarships. So if you receive a scholarship, it's non-taxable, but only the part for tuition and related expenses like fees, books, supplies. If you receive scholarship for room and board, that's taxable. Okay, so you get a full ride to school. Your tuition, your books, your supplies, equipment you need, that's all non-taxable. But if you get a scholarship for your room and board, that's taxable. Okay. If you're a university teacher or a research assistant, like you're, a research assistant supporting a professor, gives you credit or might gives you payment or whatever, you're considered an employee. And if they pay you for that research assistant or teaching, it's taxable compensation. You got a job and you're getting paid, it's compensation. So if you receive compensation for that, then you have to include that in your income. Scholarships. Some of that tuition waiver or reduction is excluded from income if you have an undergraduate tuition waiver. So the tuition waivers or reductions are excluded from income except for graduate teaching or research assistants. Those are taxable. Scholarship recipients is a cash basis taxpayer who receives the money in one tax year but pays expenses in another year. Doesn't matter, whenever you get the exclusion in the time of when you receive the money. Okay, when you receive the money. So Paul was paid $400 a month for the university for teaching. This is reasonable compensation. Although he receives the assistantship because of his excellent academic, the monthly pay must be included in gross income because it's compensation. But the graduate tuition reduction is excluded from gross income because it's tuition, not room and board. Okay. So this chapter is just a lot of listing out of different things, what's included, what's not included, So this part here, we will have damages. So we know that he got hit by a car and he received compensatory damages and punitive damages, and his mother was emotionally damaged, but not physically damaged. So when there's damages, what is going to be included in income and what is not? It depends on the type of harm the taxpayer experienced. If there's a certain type of harm, which we're going to get to, they may seek recovery for loss of income, expenses incurred, property destroyed, or personal injury. They may. Okay. If they have loss of income, they couldn't go to work, and then they receive compensatory damages of what they would have gotten paid if they had gone to work, the loss of income part is generally taxed the same unless there's a personal injury. So if I got hit by a car and I was injured and I couldn't go to work, and then I sued the person and I received money back to pay for my loss of income and I'm injured, I do not include that in my income. If I get hit by a car, but I don't get injured, but I'm very emotionally upset and I don't go to work, and I got money from them for suing them, and I got money for the loss of work, because I was not physically injured, that income would be taxed the same as if it's just replacing my income. So it's very important to know that Your loss of income is taxed unless you're injured. If you're not injured, it would be taxed. Reimbursement for expenses incurred. It's not income unless it was already deducted. So if I already deducted the expenses and then I received the money for it, it's a wash. So I already reduced my income by the expenses I paid, and now I'm getting the money back. It's a wash. So I don't have to include it in income. But if I did not if I did not do the deduction and I received the money, then it would be taxable. What if my property was destroyed? I had a car and it was damaged. Whatever amount I would have received in the sale of the property, if it was not destroyed, whatever that would have been, if I received that, there's a realized gain that exceeds the property basis. So if it's destroyed and I sell it, I made a gain on it, then it would be included as income. But if there's personal injury, there's special treatment. Excuse me. So, personal injuries. If there's personal injuries, all compensatory damages for physical injury are excludable. Compensatory damages are excludable if there's personal injury. It also includes amount received for loss of income, physical sickness. Because maybe I was in an accident where they spilled some kind of toxic gas. So I had physical sickness in my lungs. That's also the same type of physical injury. All other people who received damages are taxable. If you did not receive personal injury, then you are taxed. Compensatory damages for non-physical injury, like I'm being compensated, but I was not physically injured, that's taxable. All punitive damages, whether you are caused the harm or not, is taxable. So what does this mean? If I was physically injured, my compensatory damages are excludable. If I was personally injured, my punitive damages are included. Okay? Personal injury, compensatory damages are excluded. Personal injury, punitive damages are included. If I do not have personal injury, my compensatory damages are included in income. If I do not have personal injury and I have punitive damages, they are included in income. So all punitive damages, whether you're injured or not, are taxable. Compensatory damages are only taxable if you were not physically injured. So let's look at this example here. Oh, here's the life insurance policy. If I pay $200 a month, and if I die, my beneficiaries will receive $450,000. So let's say my premium is $200. 200 times 12 is $2,400. In 10 years, it's $24,000. Let's say my cash surrender value is $19,000. That's taxable. The balance of it was not, unless I'm terminally ill. If I transfer it, the amount of value is 24 and I transfer it for 25, I'm taxed on that $1,000 difference. That's what I was talking about earlier. So let's say I have property damages. The basis of my car before the damage was $5,000. The insurance company pays me $6,000. That's a $1,000 gain. I'll be taxed on this. If I had a $5,000 car and the insurance company pays me $4,000, I have a loss. This will follow the loss rule. So now, question, if I have physical injury, yes. Is my compensatory damages excluded from income? Yes. Is my punitive? No. I have to pay. If my physical injury is no, is my compensatory damages excluded from income? No, it's included in income. My punitive? No, it's not excluded from income. It's included. So if I have physical injury, my compensatory damages are excluded from income. If I have physical injury and I have punitive, they're not excluded from income, it means they're included. Wrongful incarceration. If I was put to jail and then finally I received damages because I was let out and they apologized because I was wrongfully incarcerated. If I received damages for being wrongfully incarcerated, that is not taxable. This only applies to an individual convicted of a federal or state crime who's later exonerated. Workers' comp. You are on the job. You get hurt. You get paid workers' comp while you're home sick. The state workers' compensation law require the employer to pay a fixed amount for specific job-related injuries. Even though they're intended to compensate for a loss, they are excluded from gross income. So this is just like write a list. Do flashcards. Wrongful incarceration, excluded. Workers' comp, excluded from gross income. Accidental health and benefits. If I receive benefits under a policy that's purchased by the taxpayer, I'm not going to be including that in my income. Okay. Disaster relief. Already talked about that. It's excluded. So back to the big picture. The damages Paul received were awarded as a result of physical injury. As a result, the compensatory damages can be excluded because he was physically injured. The compensatory damages are excluded from income. Even the compensation for the loss of income is excluded because he's had physical injury. The punitive damages are, however, included in his gross income. Paul's mother did not suffer personal injury, so her compensatory damages are included in her gross income. Employer-sponsored accident health plans. This is something you need to just read because it's just read and understand and know the law. It's not really anything hard to understand. You just have to read them, right? If your employer is paying premiums for you on an employer-sponsored accident and health plan, and they're covering, like I said, when I was a manager at Pricewaterhouse, they paid for part of my health care. I paid for the other part. I think I paid 20. They paid 80. They paid for my life insurance policy. They paid for my long-term care insurance policy. So all of those insurance premiums that they paid, okay, are deductible by the employer on their financials. So it's not it's excluded from my income. It's not me receiving that as income. Okay. And that's the code for what the employee has to include. If I, let's say, am working with my spouse and my spouse, I don't really work that much. I work maybe 10 hours a week or something like that. And instead of paying me a salary, my spouse just pays to my insurance for health insurance, life insurance, long-term care insurance. So if the payment to those policies are the only way that I get paid, then I have to include that as compensation. So what do, right? When you find out that a client's doing something like this, you go, well, you're going to get taxed on that. You might as well pay yourself something because that's a little bit less than, so you have paid less tax and get this all tax-free. Those are examples of how you would change the way you do your transactions to reduce the amount of tax you have to pay. And there's some kind of payments that do not meet the definition, and they would be included in gross income. Medical expenses on a prior return are included in gross income. What does that mean? Let's say, for example, in 2022, I had some medical expenses that I deducted on my tax return, which that reduced my gross income, which reduced the tax that I paid. So because I got a lower tax rate, now that I've received that income, I have to include it in my gross income. And then whatever that amount would be would basically make it whole. I pay tax. My income, let's say was $20. Let's say it was $2,000. My medical expenses went down by $2,000, which reduced my taxable income. Now I'm receiving the $2,000, which makes my taxable income go up by $2,000, and so that difference would be a wash. And you can read about medical reimbursement plans. Long-term care insurance benefits are kind of going away because insurance companies don't want to cover these anymore because you don't know how long a person's going to be gone or out, and so they can't figure out what the payment should be. So what happens is a lot of times they have a life insurance policy that has maybe a 20-week long-term care option within it. So if your employer pays this premium, it's excludable, but there's an annual limit. Meals and lodging. They're not taxable to the employee. So your employer gives you meals or lodging, or you go to a client and your boss is paying for it, right? It's not taxable to you as long as it's furnished by the employer. You're on employee's business premises, and it's a convenience of the employer. So this is for really meals. So the meals are furnished by the employer, or they're going to reimburse you. It's on the employer's business premises and convenient for the employer. Now, it used to be that your employer would pay for your meals, like way back in the day, like 30 years ago. Excuse me. Like the big brokerage houses, they'd come in the morning, they'd have all of this like omelet bars and breakfast bars and carts around the office, and then lunch coming in, and then dinner coming in, and all that stuff, because the IRS used to allow a deduction for meals that you provided to your employers, and you got a deduction of the whole thing, 100%. Well, now the deduction's only like, depending on, it's between 0, 20, 50, and 60%. They don't actually get the whole thing deducted. So now they don't actually do that type of stuff that much anymore because the deduction's kind of gone away. So between 2018 and 2025, the employer may only deduct 50% of the cost of the meals provided rather than the 100%. It used to be 100%. Now it's 50%. But then there's actually more line exclusions and exceptions. After 2025, the employers may not claim any deduction for meals. So it used to be 100%. Then from 2018 to 2025, it's 50%. And going forward, it's 0 after 2025. So there'll be less employers paying for people's meals. If the employer continues to provide meals to their employees, their value remains an exclusion for the employee. So if my employer is going to pay for my meals because I'm working late, I still don't have to include that in my income as a benefit. Other housing exclusions. Campus housing, before I said room and board, is if you receive a scholarship for room and board, it's taxable. It's included in your income. But if you're provided campus housing by an employer of an educational institution, if the employee pays annual rent equal to or greater than 5% of the appraised value of the facility, it's excluded. And otherwise, the difference is included in gross income. So sometimes there's corporations that are very, very big, and they've got kind of locations, and they own apartments, and they provide apartment housing to employees because they work a lot of hours or whatever. Excuse my yawning. So if the amount that the employee pays is equal to or greater than 5% of the appraised value of the facility, it's excluded. And the difference is included in the gross income. Ministers of the gospel, and they give you examples in the book. Ministers of the gospel and other religious leaders can exclude the rental value of their home as compensation. It's excluded. The rental allowance paid to them as compensation to rent, buy, or provide a home, or the rental value. Those are all excluded if you're a minister. So like, again, these are just a list of different things that are excluded. Military personnel are allowed housing exclusion under different circumstances. It all depends. A fringe benefit. A fringe benefit is an extra benefit that employers give to an employee. There's a whole bunch of different types. Like, for one example, is child and dependent care, or athletic facilities, educational assistance, adoption assistance. So if your employee provides child and dependent care on their site, so when I worked for PricewaterhouseCoopers, they actually had a daycare in the building. You can exclude up to $5,000 a year. So the PwC would, if you had a child there, they would say, let's say it cost $20,000 a year to bring your child there. You're not paying that, but that's the value that you would have gotten. Well, 25,000 of that would be included in your income, and 5,000 would be excluded. Because they're giving you this free healthcare as a benefit. So it's kind of considered a compensation. Athletic facilities. Sometimes if there is athletic facility on the premises, it could be excluded from your income. You go back to school and your employer says, we will pay for you to go back to school. It's excluded to your income up to $52.50 per year. So if your schooling costs $10,000 a year, then only $52.50 is excluded. The rest of it, you would be taxed as income. This is only for tuition fees and books. It does not cover meals, lodging, and transportation. All of that would be extra and taxable. You want to adopt a child, and there's a lot of fees for that. And your employer says, we're going to help pay for that for you. Well, anything up to $16,810 is excluded from your gross income. Anything above that, it would be included as compensation income. And that would be phased out if you make more than this much money. A cafeteria plan is when employees can choose between different types of benefits or cash. So if you choose the cash, whatever cash you receive is taxable. If the non-taxable benefit is chosen, the benefit remains non-taxable. So if you choose the non-cash benefit, whatever it is, like there's all different types of plans, which you can read in your book. There's more details, right? Flexible spending. Your employer allows you to accept lower cash compensation, and then the employer agrees to pay certain costs without the employee recognizing income. There's a cap on that. So if you go over that cap, it's $3,200 a year. Now, excluded benefits. No additional cost services, qualified employee discount, working continuous. So these are all just a list of different types of things that are excluded. Okay. It's just listing out what they are. So value of services is non-taxable if the employee receives the service, not property. So, for example, it might be if you work for a CPA firm and you're not a CPA, maybe you are a lawyer, and the CPA firm is going to do your tax return for you for free. That's no additional cost services. It's non-taxable if you receive services. You received your tax return done. So you receive services. There's no additional cost. They're offered in the ordinary course of business where you work. So if you worked at a CPA firm, they did your taxes, your ordinary course of business. If you worked at a restaurant and somebody did your tax return, that's not in their ordinary course of business. So that would be taxable. They're not allowed for highly compensated employees unless there's a non-discriminatory basis, which means if there's a lot of highly compensated employees, which prevents you from offering services to your whole company, because there's more highly compensated employees than the less compensated employees, and then the less compensated employees can't get some benefits that they would need. As long as that they're all receiving this service, because if they didn't, the low compensated employees would not be able to get it. That's a non-discriminatory basis. Non-qualified employee discounts. You work someplace and they give you a discount. They're non-taxable if it's not on real property or property held for investment. They must be from the same line of business in which you work. So kind of all the same rules. In case of property, it's limited to gross profit. De minimis. De minimis means a low amount, a small amount. The benefits are so small that accounting for them is impractical, and so they exclude them. Occasional dinner money or taxi fare because of overtime work, or personal use of the company copying machine, or cocktail parties or picnics, or holiday gifts with a low fair value. That's de minimis fringe. Sometimes when you work in a company, they have, instead of you going out to restaurants to get money or go to the deli to get your lunch, they actually have a floor that's got a cafeteria on it. And so, and the business pays a cost for that cafeteria to be there. And so that way, when you go get your lunch or a meal or something like that, you're not actually paying a lot of money because the company's paying a bulk of it, and you're actually getting a lower cost meal. Cash or gift cards are not considered de minimis. Those are considered income. The value of a cell phone can be excluded if it's provided for business reasons. Qualified transportation. This is a fringe benefit to use mass transit. So if the company says, we're going to give you a transit pass or an MTA card, or we're going to pay for your tolls, and they give you a Metro card for the month. Well, you can exclude from your income $315 of whatever that amount was, how much it costs. Qualified parking, $315 per month. Okay, if your transportation costs more than that, then usually a corporation will just give you a card for $315, whatever that limit is. You don't have to include that in income because it's something that they're giving you, but you don't have to include it in income. Moving expenses. It used to be, if I was going to move from one job to another, and I was going to go, let's say, from New York to California, I'd have to fly out to California to look for a new place. I'd have to work with a broker to find a new place. I'd have to get a hotel room while I'm there or a rental car to find a new place. And then I found a new place and I have to pay the bank, closing costs and stuff like that. Then I have to hire a moving company to move all my stuff over. And then I have to, buy a new car because when I was in New York, I didn't have a car, but in California, I need a car. All of those things would have been qualified moving expenses that your employer would have paid for, and they would have gotten a deduction for it on their tax return. And it would not be taxed to me as income. But then in 2017, a lot of the laws changed and all of that went away. The only people who are allowed to deduct moving expenses are members of the armed forces on active duty, because they're being moved and they're on active duty. So all those expenses I just described, they would be able to deduct. If they got reimbursed, they wouldn't be taxed on it. And the employers would be able to deduct that on their tax return. So that's a big loss there. Qualified retirement planning services. So let's say, for example, you're working for a company. You've been working there for about 5 years, and you've done really well saving, and you bought a house, and now you want to make sure that you're setting up a good retirement plan for yourself. And let's say your employer provides a consultant to come in and talk to all their employees about making sure that they're planning for their retirement. So any retirement planning advice or information that the employer gives you, whatever that cost might be, it's excluded from your income. Okay, it's designed to motivate more employers to provide retirement planning services for their employees, because the IRS wants people to plan for retirement now, so that when they get older, that they're not relying on the government. Military base realignment is excluded from income, and you can read more about those. Group life term policy. Foreign earned income. If you have income from a foreign country, okay, you can either include the foreign income in taxable income and then claim a credit for the foreign taxes paid. So let's say you have you worked in a different country for part of the year and you had to pay that country taxes. Well, you can include the foreign income on your personal tax return and then have a credit for the taxes that you paid to the foreign government, so that you're not being double taxed. Or you can exclude up to $126,500 of foreign income, earned income from U.S. gross income. It all depends which one would be beneficial to you. Whatever election you make, this one or this one, it applies to all years unless you revoke it, affirmatively revoke it. You have to actually write a letter to revoke it. That revocation is effective for the year of the change and 4 subsequent years. Okay. To qualify for the exclusion, the taxpayer must be a bona fide resident of the foreign country and present in a foreign country for at least 330 days during the 12 consecutive months. Okay. So it's basically take that out. I said 6 months. Forget that. They changed the rule to 330 days. So you're working in a foreign country. They don't want you to get taxed twice. They're telling you 2 different ways that you can do this. Whichever way you pick, you're electing it, but you can revoke it, but it'll only last for 4 years. There's your 126 exclusion. Interest on some state and local obligations. So that would be over here, right? Tax exempt interest on your page 1040, line 2A. Qualified interest on a municipal bond is tax exempt. It's basically, what is a bond? So let's say, for example, New York City wants to, like, they just built the Second Avenue train, a subway line over the last, I think it was 10 years or 15 years. I remember when they started working on that. Well, how is New York City going to pay for that? Right? Well, they can go to the bank and ask to borrow money, but then they have to pay closing costs, and then they have to pay the bank back interest, and they have to, once they borrow it, they have to start paying right away. And then the banks will always have these rules, like you have to provide us with your financials every year, and you have to have a debt to equity ratio, and there's all these different rules when you borrow from a bank. Or you can borrow from the people. So what's borrowing from the people? Well, a bond is a debt instrument. So New York City says, we're announcing that we're selling bonds. Pretend this is a bond. We're selling bonds. So if you buy a bond, means we're going to give you a piece of paper, a bond. And the bond is worth whatever you pay, $1,000, $10,000, $5,000, whatever it is. So we're going to give you this piece of paper, which is a bond payable to you for $5,000. And you give me $5,000. And it's going to say, let's say the bank was going to charge 5% interest. I'm going to charge 2% interest. So now I have no closing costs, no nothing. A bond is basically asking to borrow money from people. You give me the $5,000, I give you this basic bond, which is basically an IOU. You have the piece of paper, and then you can say, now I want this money back, and you have to pay me 3% interest. So instead of me paying interest to the bank, I'm paying interest to you. And the bank is usually 5% or 6%. It's usually a higher amount. So I'm saving money on interest, and I'm giving it to you. And people will buy bonds because they're a low risk entity or transaction. And I'm giving you interest, but it's at a lower tax rate. So whatever interest that you earn is not included in your taxable income. It reduces the state for local, the cost for local government. So if I went to the bank and they were to charge me 5% and I'm going to pay you 3%, I just saved 2% of borrowing costs. Okay. So those are some examples. Savings bonds. Savings bonds are government savings bonds. If you receive interest from a government savings bond, it's excluded from income. If you use the proceeds to pay for a qualified higher education, and the bonds are issued to a person at least 24 years old. There's a phase out if you have over 96,800. What's a 529 plan and a 530 plan? 530 plans are new. A 529 plan is, I'm going to put money away for, I did a 529 plan for my nephew. I put away money for him every month in a 529 plan. And then every time he got, not every month, every year, for his birthday and Christmas, instead of giving him gifts, I put money into an account because there's so many family members giving him all these gifts, stupid toys that he didn't even play with. So what happens is that fund is going to earn interest. And then that interest is tax-free as long as the money is pulled out and paid for higher education expenses. It's paying for your tuition. For your tuition, fees, books, room and board. I'm basically saving. So once my sister had my nephew, I opened up a 529 plan when he was 2 years old, and I kept putting money in. And then every time my sister received money from anybody for Dylan, that's my nephew's name, Dylan's birthday, Christmas, whatever, any money she ever received, she put into the 529 plan because she was saving for him to go to college. And the amount of interest that you earn is great. So whatever interest you earn, as long as the interest and the money that you use goes to the college, you don't pay taxes on that interest. Okay. There's a lifetime maximum of 10,000 in a 529 plan. Coverdell is an education savings account. It's used from K through 12 and some post-secondary. The contributions are limited to $2,000 a year. You might put $2,000 away. It's basically non-taxable. It's a savings account to save for money. Must be under 18. You can look at the rules. The ABLE program, that's new. Achieving a Better Life Experience, was to assist individuals who become blind before age 26. Works like a 529 plan. It's a similar concept, but it's called a 529 ABLE plan. It must be established by a state, and it must be the benefit for the disability expenses. And then there's a limit exclusion. You owe somebody money, and they say, you know what? You don't have to pay me anymore. That's a discharge of indebtedness. Indebtedness is a debt. Discharge means you don't have to do it anymore. You don't have to pay me anymore. So let's say I lent you $5,000. Now you owe me, you're indebted to me $5,000. And I say, you don't have to pay me. I'm discharging you from that. That $5,000 that you don't have to pay me is income. That's taxable. So income from the forgiveness of debt is taxable. A creditor's gift. That's excluded. A creditor, you owe money to a creditor and they give you a gift of not paying them back. So income from forgiveness of debt is taxable except for these. These are not. These are excluded. The discharge from federal bankruptcy law. You owe all these companies, you file for bankruptcy, that debt you don't have to pay tax on. When the debtor's insolvent, I've got no money. And they discharge it because I've got nothing. I can't pay taxes on it, so they're not going to tax you on it, okay? So those are examples of where the debt and discharge of indebtedness is excluded from income. And there's some more. And there's some knowledge checks for you. The tax benefit rule, what does that mean? If a taxpayer claims a deduction for an item in 1 year, like the medical expenses I talked about earlier, you had a medical deduction of $5,000 in 1 year, and then in a later year you recover all or a portion of it, well, you got a tax deduction for that $5,000. It reduced your income, which reduced your tax. Well, the IRS says, but now you've received that income, so you have to pay taxes on that income because you received a benefit of lower taxes when you deducted that. And this happens when, a lot of times this happens when there's a damages or injury and you have all these expenses. You have to pay the doctors, or you have to pay your lawyer, you have to pay whatever it is. So you expense it that year because you don't necessarily get paid back in the same year. You get paid back a year or two later. So you want to do a deduction in case you never get paid, right? Because you have to do the deduction in the year that it happens. But the tax benefit rule is you had a benefit for the deduction. It reduced your gross income, which reduced your taxes. But then later on in another year, you received that income. So you're going to include that income in the year you received it. Now, what happens if you had all those medical expenses, but you did not deduct them in your tax return because you trusted you were going to receive a reimbursement for that? If you never deducted those expenses in a previous year and you received the $5,000, you do not include the $5,000 in your gross income because it's paying you back and you didn't take a deduction, so you didn't get a benefit. You didn't lower your taxes by putting an expense deduction there. The tax benefit rule is if you deducted it and later on you received it from somebody else, like a repayment, then you get taxed. But if you never deducted on your tax return and then later on you got paid back, there's no including it in your gross income because you never received a benefit by having a lower tax rate. And there's some more knowledge checks for you there. So refocusing on the big picture. Compensation. The amount Paul was paid for his internship is compensation. It's included in his gross income. The graduate assistantship, the tuition is excluded because it's a tuition waiver, but the amount he's getting paid is a compensation. You include it in gross income. The damages, the compensatory damages are excluded because he was injured. The punitive damages are not, they are included. It doesn't matter if he's injured or not because all punitive damages are always included in gross income. The money that the mother received is included because she was not injured. So compensatory damages, you exclude them if you were injured, you include them if you were not. And there's some what ifs there that you can look at. So hopefully this was helpful. And if you have any questions, please always email me and we'll set up a Zoom call to go over whatever questions you have.